Well, a warm welcome to everyone tuning in, whether you're an investor, retiree, or just keeping an eye on the economy. I'm glad to see you here. It's time for your August 2025 Investment and Economic Snapshot brought to you by Solace. Markets have been buzzing this month, from equities to commodities to central bank moves. So let's get straight into what's happening, what it means, and what to watch. Globally, August delivered strong results. The MSCI World Index rose 2.6%, driven by growing confidence in potential interest rate cuts and strong corporate earnings. In the US, the S&P 500 was up 2%, while the Russell 2000 surged 7%, showing a return to favour for small-cap stocks. Earnings season was impressive. 81% of the S&P 500 companies beat expectations, with tech and communication sectors leading the way. Back home, the ASX 200 gained 3.2%, taking its year-to-date return to 12.3%. Top performing sectors were minerals, consumer discretionary, and utilities, all seeing solid growth. Meanwhile, healthcare and technology lagged behind. The earnings season was upbeat. More companies beat expectations than missed, thanks to strong margins and solid cost management. Shareholders also saw a boost through dividends and buybacks, supported by a strong balance sheet. In commodities, we saw some interesting moves. Gold climbed 4.4%, investors still chasing safety. Iron ore rose 3.6% on the back of a huge $250 billion hydroelectric project in China. Oil, however, dropped 8.5% as OPEC announced earlier than expected supply increases. And lithium rebounded after a major battery maker suspended operations at a key mine, raising supply concerns. In fixed income, US Treasuries fell. The 10-year ended at 4.22%, driven by softer employment data, increasing expectations of a Fed rate cut as early as September. In Australia, we actually saw a rate cut. The RBA dropped the cash rate by 0.25% to 3.6%. Why? Well, inflation is easing, and the RBA is shifting its focus to maintaining full employment. However, trimmed mean inflation did rise slightly, so the central bank remains data dependent going forward. In the US, the economic picture is a bit more complicated. Labour markets look softer, which supports a rate cut, but inflationary pressures, particularly from tariffs, are still in the mix. Producer price inflation rose, raising concerns that consumer prices might follow. And with some political turbulence, including the controversial removal of Fed Governor Lisa Cook, uncertainty around Fed policy has only grown. Now for some important news for retirees and Social Security recipients. From the 20th of September 2025, deeming rates are going up for the first time since 2020. The low rate increases to 0.75%, and the upper rate moves to 2.75%. The government says this is the first of several increases, aiming to gradually return deeming rates to pre-pandemic levels. The changes reflect an improving returns available in low-risk investments, and they'll be reviewed again in March and September in 2026. So what's the big picture? Markets are still being driven by solid company performance and the shift towards easing monetary policy, but risks still remain, from global trade tensions to political uncertainty and uneven economic growth. For investors, it means staying patient, staying flexible, and staying grounded in fundamentals. Thanks for watching this month's Market Snapshot. If you found it helpful, give it a like, subscribe for more updates, and let us know your thoughts in the comments. Until next time, we'll be watching.